Welcome back. In today's video, we will finish Chapter 4, Tenancies. Let's get started, but first with a review. In Part 1, we talked about what tenancy is, which is the options to hold real estate. We also talked about the different types of tenancies. For one, tenancy in severalty, and that is the sole ownership by one person. We also introduced concurrent ownership and the different types of concurrent ownership, including tenants in common, joint tenancy with the right of survivorship, community property, tenancy in entirety, and dower and courtesy. In today's video, we're going to talk about tenants in partnership. There exists a type of tenancy called syndication. It's a big word, but it's actually very simple. What it entails is a group of investors, and they own and operate real property together. And the benefit, of course, is that they have the potential to make more money. Normally, these investors or syndicates would form some type of organization together. There are several options for them to go with. Number one, they could do it through a partnership. There are two types of partnerships, general and limited. General partnership means that all the partners are equals, and this equality applies to general operations, management, and decision-making. One partner can be assigned an agent, but the profits are shared equally. If one partner has debts or liabilities, all partners can be sued together or severally, which means they can be sued individually. The downside of this is that personal assets can be used to pay lawsuits or debts. And if one of the partners passes away, files for bankruptcy, or for some reason withdraws, then the entire general partnership is dissolved. In a limited partnership, there's one general partner and he or she is the managing partner. This person is personally responsible for all partnership debts and liabilities. Of course, the other limited partners in management and operational decisions. Of course, limited partnership can dissolve as well, but the death of a limited partner does not cause the partnership to dissolve. One great advantage of partnerships is partnerships are not taxable entities. And what that means is profits and losses are passed on to their personal taxes. So say within the first 3 years of your investment, you take a loss, you may actually get some tax refund. But there are also some disadvantages. For one, there's a lot of trust built into partnerships, so they're not easy to sell. The general operating partner also has to be responsible for all partners' debts and liabilities. In other words, if you want to become a general partner, you have to be very committed and very trusting. And last, if you're not a general partner and the partnership is limited, well, you kind of have no say in decisions. So even if you feel like things should be run a certain way, you have to be incredibly persuasive. The next type of syndication is a corporation. It is a legally bound entity that holds ownership in severalty. And again, severalty means ownership of one person or one complete entity. A corporation is open to have tenants in common, but not joint tenants, mainly because the entity is perpetual. So what are the advantages of establishing a corporation? Well, for one, it is perpetual, so survivorship doesn't really matter because if one of the officers dies, business goes on and stakeholders are not monetarily impacted. The corporation also has an easier time raising money. It can also acquire bonds and notes and issue and sell stocks. And of course, stockholders would only lose what they invest into. So there are no personal liabilities. Of course, there are disadvantages as well. For one, corporations they're very expensive to run. And of course, decisions are hard to make because normally there is a board of directors and their opinions can really conflict with each other. A corporation is also subject to double taxation. The company's profits are taxed and so are its dividends. And if there are losses, shareholders cannot report that on their tax return. If a corporation does not want to be double taxed, it can establish itself as an S corporation, which means that stockholders would have to declare their profits and losses on their personal income. And to establish an S corporation, you will need at least 75 shareholders. Plus, they all have to agree to establish as an S corporation. Last but not least, there is the limited liability company, and it combines the benefits of both a corporation and a partnership. LLC members are shareholders, but they're tax-like partners. So they get the benefits if there's a profit. So if the company makes money, they get the profits, but if there's a loss, then they can file it on their tax return. Related to all of this is a concept called the joint venture. And what that means is all of these investors, they would invest in one particular project or transaction. So it is not continuous like all these other syndications. And when the venture ends, everyone goes their happy ways, and hopefully with profits. Last topic of today's study notes is trusts. A trust is something that is created by a truster to convey title of property to one or more trustees. A living trust is created when the truster is still alive. If there is one trustee, he or she will have tenancy in severalty. If there are more than one trustee, they will have joint tenancy. By the way, the truster can also sell the property and give all the sales proceeds to the trustees. So the trust really is like an instrument of fiduciary for the beneficiaries. And the beneficiary can really treat the trust as personal interest. When they receive the property, they can transfer it, they can use it as security for a loan, or they can will it to their heirs. So if you want to transfer an actual piece of land, there is a concept called the land trust, which transfers the legal title to a trustee. You can also create a trust from an investment. It's acronymed REIT and stands for Real Estate Investment Trust. This is more for long-term investments, and what it does is that it provides trustees with long-term income. So if you want to take care of your family for years and years to come, you can do that through investment properties, say rental properties. And also, if you sell it, trustees will get the capital gain. Also, this type of trust does not have to be subject to double taxation. There are some conditions that must be met though. Number one, you have to have at least 100 people. Out of those 100 investors, 5 cannot have more than 50%. At least 75% of the assets must be in actual real estate. And at least 90% of the earnings has to be distributed to the investors, and do so annually. So before you decide to make that type of investment, there's a lot to think about. And we are at the end of today's study notes. This concludes chapter 4 on tenancy. Next topic, conveyances and deeds. And don't forget to share, like, and subscribe. See you next time.